rates in the Treasury Bills market inched up by about 10 basis points in Thursday's trading session. The traders at Axis Bank said they expect a similar trend in today's trade, despite the thin liquidity levels at the market. Akpevwe Oputu, money market trader at Axis Bank, joins me for a weekly market wrap. Akpevwe, thank you so much for taking the time out to join us today. I'd like you to just bring us up to speed on trading on the different market segments, starting from the money market, treasuries, and then we can move on to the bonds market.
Okay, thank you for having us on the show. So at the money market space, we've seen illiquidity persist in the market as it's been from the beginning of the week. So most banks have been seen to access the CBN repo window as well as the ILF window to cover their intraday obligations. And despite the fact inflow that we received into the system on Monday, we've still seen some banks taking funds from the CBN window. At the Treasury Bill market, we've seen yields elevated at the short end of the curve as most banks try to sell off on their securities to raise liquidity to fund their intraday obligation. And this trend has persisted from the beginning of the week up until today. So we've seen yields trade as high as 11.1% and the October-November maturities, and this due to the liquidity that's been in the system. Same for the bond market. We've seen the mid and the long end of the curve trading above the stop rate at the last auction. We've seen the 2036 bond trading as high as 12.65%. You must remember that the bond actually closed around 12.5% at the last bond auction. So this increase in yields as a result of the liquidity in the markets as participants try to sell off on their securities to fund their intraday obligations.
Now, from what you've seen, let's dial back a little bit. In the last 2-3 weeks, how would you describe investors' playbook in terms of how they've been playing the market? I know that not much has changed in terms of liquidity levels in and out, high, low sometimes. But how would you describe the trading strategy of investors in the last 2-3 weeks?
Okay, so we've seen improved investor appetite because investors are clamoring for higher yields in the markets. There's been illiquidity, like I mentioned, in the money market space, and this has raised the rates up at the fixed income market. Even in the money market space, we've seen most of the pension funds, the custodians, asking for rates as high as 12%. So we've seen yields trading higher in the secondary market as well.
What can you tell us about, let's switch gears a little bit to the corporate bond market. I've had conversations, I believe, with you and some of your other colleagues on the prospects for the corporate bond market this year. I believe things looked a little bright this year, but, with increased participation of the federal government, of course, borrowing on that end, it looked like things weren't going to pan out for the corporate bond market. I could be wrong. Things could have changed, but, just bring us up to speed on what you're seeing right now.
Okay, even in the bond market, we've still, like I mentioned, investors are also clamoring for higher yields on that space. So we've seen bonds coming into the market trading as high as 12.7%, and we've seen corporate organizations issue several bonds in the market, and yields are expected to trade around 12.7 to 13% for about a 207 days bond right now in the market.